Firstly, when you are comparing two different home loans, you should not use the interest rate or the comparison rate as a basis for comparison. The fees on a lower interest product may actually make the repayments higher than a higher interest product with no fees. So use the repayments on the actual loan amount that you're applying for as the basis for comparison. Don't look at the comparison rate. The comparison rate was a thing that was brought in about 10 years ago. The comparison rate assumes that you're taking out a $150,000 home loan, which is around about half of the average actual mortgage amount in this country. So I don't even know why it's a rule that banks must disclose the comparison rate, because it only is an accurate comparison rate if you are applying for a $150,000 home loan. So if you're applying for 150K, yeah, go for it. Use the comparison rate as the basis for comparison. If it's an amount that's different to 150,000, then compare the actual repayments. Also, have a look at the features, and don't pay too much for fancy features just because they seem fancy. For instance, I'm going through a stage of moving away from recommending offset accounts, and here's why. I have found that in my database of 1,800 clients, 9 out of 10 on average are not actually using their offset account properly. So it sounds good in theory that obviously you're going to be running all your money through an offset account to minimize the interest that you're paying and therefore pay off the loan faster. Sounds good in theory, but it only works if you do that in practice. So if a product is offering an offset account, but the repayments on that product are substantially greater than the basic product equivalent of it, then really ask yourself the question, am I disciplined enough to use the offset account properly? In fact, I think you can only answer yes to that question if you have demonstrated a track record of using an offset account properly. So yeah, just don't overpay because of the the fancy features, and ask yourself which features you are going to use. As far as whether to fix your home loan or not, again, I normally recommend variable, and for the reason that historically there's been very few times that a fixed rate is actually beneficial to the client instead of being beneficial to the bank. Ask yourself the question, why would a bank offer a fixed rate? Would it be to benefit you or to benefit them? The banks are very smart. Well, that's arguable, but they do hire some very smart people to work for them. Leading economists that can forecast future interest rate movements, and they're the ones that basically determine what the interest rates and the fixed rates should be. And I can tell you that it will almost always work in the bank's favour if you have a fixed rate. Also, another danger with a fixed rate is that they have potentially really large break costs. So for instance, if you take out a 5-year fixed rate and you decide that you want to refinance or buy an investment property within that 5 years, you could pay a lot of money to break that fixed rate. So just be careful of that as well. But yeah, there are circumstances under which a fixed rate may be suitable, and definitely talk to an experienced mortgage broker